Hello and welcome to CMS Forex Daily Video Recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, October 8th, 2010. The main story today was that the dollar weakened against most of its major rivals after we had a weaker than expected U.S. jobs report. That lent credence to expectations that the Federal Reserve extra stimulus in the form of some quantitative easing may be just around the corner in order to lift the sagging economy. The non-farm payroll report showed a loss of 95,000 jobs for the month of September, which was weaker than the flat reading expected by economists. Now, most of that decline came from 77,000 temporary census workers being laid off, as well as 49.8 thousand in local government jobs, mainly teaching. So if we look at private payrolls, we actually see private payrolls rising by 64,000, which followed gains of 93,000 and 117,000 in July. The unemployment rate remained at 9.6%. Forecast did have it rising to 9.7%. So while the private sector growth is positive and shows that companies are higher again, seeing the government jobs showing such a decline means that the budget pressures that states and local governments are under are causing those layoffs. So that will play a role in slowing down growth going forward. Also, from the private sector side, the amount of jobs being created is not enough to lower the unemployment rate. So again, that'll be a strong signal for the Fed to take action in the form of more quantitative easing. Now, prior to the non-farm payroll report, we did have James Bullard, the president of the Federal Reserve Bank of St. Louis, say that quantitative easing was not a done deal, but this may be more a Fed speaker trying to manage expectations of the market. So let's turn to our market highlights and start with the dollar-yen pair, where we saw the greenback dropping to a series of 15-year lows, weakening as far as 81.72 and putting investors on alert for signs of Japanese intervention in order to stem yen strength. As we can see, we sliced through the 82 handle in today's trading following that non-farm payroll report. And if we zoom this pair out, we see that we are now pretty far below the area at which the Bank of Japan intervened in mid-September. So we do have an IMF meeting over the weekend, so the Japanese authorities were likely not ready to intervene and then have to answer those questions during the IMF meetings. But coming back from the weekend, we could see some form of intervention. So very important to keep an eye on this pair, even as early as the open on Sunday, as there will be some developments from the IMF meeting that might be priced in to the dollar-yen when we come back. Turning to the euro-dollar pair, we see a very volatile candle in the 1 hour during the non-farm payroll release. We see that we went as low as 1.3850, then as high as 1.3983 as the dollar weakened following the release. But then we saw the euro pairing some of its gains, and we wind up trading kind of close to where we were to start today's trading session, around 1.3930. Now, following the report, we did have the head of the Euro Group of Finance Ministers, Jean-Claude Juncker, say that the euro was too strong and did not reflect the region's economic fundamentals. So it seems that Eurozone officials are upset that the pair has gone all the way up to 1.40 and is knocking on the door to move above that barrier. So we'll see if there's some more talk coming from Eurozone policymakers in terms of the strength of the euro. Now, there are a lot of stories about so-called currency wars happening now, in that many of the main economies are undertaking quantitative easing and are trying to weaken their currencies in order to help bolster exports. So that's a very important story heading forward, and I'm sure we're going to hear a lot coming out of the IMF meeting from the weekend. But out of the major currencies, the euro is the only one not conducting some kind of quantitative easing, and so it has been strengthening compared to the dollar, obviously, over the past month. Now, taking a look at our main commodity currency pair tied to global growth concerns, the Australian dollar, US dollar, we see that it bounced off rather nicely from the 0.97 level, which was both our 200 period moving average in this pair, and a very important level of resistance from last week that has now turned to support. So that's a pretty classic way to see a power line, which at first was important resistance, but then retested as important support. So we see here, following non-farm payroll, we moved all the way up to 0.9870 in the pair. Now, yesterday we moved above the 0.99 level, which was the highest, if I'm correct, the highest this pair has been since the Australian dollar was floated freely. So we might start to see some resistance for this pair. It too has been on a tear during the last month, but once we get closer to parity, we'll see if there is some let up in the pair. But for the most part, the Aussie stays very well supported from its fundamentals, as well as interest rate differentials and quantitative easing concerns for the US dollar. And a look at another currency tied to commodities and global growth, but which is more closely tied to the U.S. economy, the U.S. dollar, Canadian dollar. We see that we had broken below an important level of support in this pair at around 1.0230. We could see that we had tested that level several times throughout the past month, right? Now we broke below that level to start this week's trading, and in today's trading we had moved back to retest that level, and just like with the Aussie pair, we see that we tested the 200 period moving average here. But following non-farm payroll and the weakness in the dollar, we see the Canadian dollar reclaiming its losses from overnight and most of its losses from yesterday's session, and we traded around 1.0110 at the end of the trading for this week. So that's the story. For the most part, the greenback continues to be on the back foot against its major rivals. And coming back from the weekend, the speculation around quantitative easing from the Fed should continue to pressure the US dollar. Turning now to next week's key releases. First, let's focus on the US. On Tuesday, we get our meeting minutes from the latest FOMC meeting. Following that, we'll get the federal budget balance on Wednesday. Then, the end of the week, we get a couple of good reports. We get producer prices, consumer prices, the trade balance, and retail sales, all on Thursday and Friday, as well as the preliminary version of consumer sentiment and Thursday's weekly jobless claims. So that is a good amount of data that will be coming out, though later in the week. In the rest of the world, Tuesday and Wednesday, we get a couple of important reports from the UK, including consumer prices and the UK claimant count, the measure of unemployment for the month. On Wednesday, we also get China's trade balance release that is important to global growth outlooks. Wednesday, New Zealand posts its retail sales, so that could have some risk event for the New Zealand Kiwi. On Thursday and Friday, we get a couple of reports from Canada, including its trade balance and manufacturing sales. So those two reports can affect the Canadian dollar towards the end of the week. And so with that, we wrap up the coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site, cmsforex.com. I want to thank you for watching and wish you a good weekend.